Great, great. We're going to go ahead and get started. We are so excited to have you here for day two of Climate Catalyst. Hopefully, many of you were able to join us yesterday. We had some fantastic programming. If you did miss anything, we will be sharing the recordings of those sessions very shortly, so stay tuned for that email. I'm Jessica Winger, Program Lead for ClimateCAP if we didn't meet yesterday, and I'm joined today by ClimateCAP co-founder Katie Cross, who's going to be helping to support through this session. And instead of an intro, since we did a lot of those yesterday, if you don't mind in the chat, kind of starting this by sharing maybe your favorite climate book or podcast or kind of thought leader that you've been listening to lately, we'd love to hear what is catching your attention. We're so glad to have you here. As I said, this session is going to be really exciting climate policy as a key lever for the energy transition. We're incredibly lucky to have Elizabeth Doty, who's the executive director at Third Side Strategies, to lead our conversation today. And as you've probably seen very clearly in recent months and years here in the US and around the world, that climate policy at every level is one of the most important drivers in shaping the different market dynamics that we're seeing, the cost of capital for clean energy, climate tech projects. It's really having a major influence on the way that business is being done. So today, Elizabeth is going to get us up to speed on some of those issues, some of the terminology, some of the trends shaping those energy markets today. Very excited to jump into this session with Elizabeth, but I'm going to take it just a second to introduce ClimateCAP because we may have some people who weren't here yesterday when we kicked everything off. But just as a reminder, we have a lot of different programs within ClimateCAP, from our fellowship to the summit, our virtual education programs, Climate Connects, and our educator collaboration. You can find out more about all of these on our website, but I'm going to highlight really quickly our ClimateCAP fellowship for you. So this is a year-long immersive experience that empowers a select group of MBAs to become the next generation of climate leaders and change makers. We're on our fourth cohort this year, and you can see their lovely smiling faces when we were together at the summit at MIT back in April. And key elements of the fellowship include learning and development sessions, networking, and self-directed project work, where students design and implement their own climate action project. We can find out lots of information about this cohort, as well as previous cohorts and overall program information on our website. And the applications for the next cohort will open in very early October of this year. Typically, students apply for the fellowship in the fall of their first year, if they're in a 2-year MBA program, just to give you some idea of the timing. So if this interests you, definitely check it out and start thinking about it. Lastly, before I turn it over to Elizabeth, I want to thank our sponsors who've made this program possible, Deriva Energy, Apex Clean Energy, and Environ. And you can learn more about all of those organizations and their climate work on our website. But for the reason you're out here today, that's to learn about climate policy. We've shared Elizabeth's full bio on our registration page, so we're just going to jump right into it. And as a reminder, please use the QA function at the bottom of your Zoom screen to submit any questions that you have at any point during the session, and we'll get to those at the end. And with that, I'm going to turn it over to Elizabeth. Thank you for being here.
Great. Thank you so much, Jessica. I'm very glad to be here. And as you can tell, it's been a long time since I took that photo. I'm going to have to get a new one. And I would like to share a book as we get started, that's not an obvious one, but might be helpful to people. It's called by Chelsea Henderson. It's called Glacial. And it's about the history of climate action, in particular climate policy, since the late 70s, a lot in the early 2000s. And I think it will help put some historical perspective on the magnitude of the challenge we have, and also give you some ideas of where there's opportunity and where there has been more consensus in the past. So thank you very much, and I'm delighted to be here and have this conversation with you. It's a complex topic, and I know I will learn as we go through your thoughts. I'd like to start just as you are getting oriented to your work on climate and the role it plays in your MBA education and your future career. What are you seeing as the most compelling arguments for business to invest? Right? We all have an interest as citizens, as neighbors, as parents, as grandparents for someday. But why business? Why should business get involved? What do you consider the most compelling arguments? I'll give you a second, and why don't we, if you don't mind, just add that to the chat, and I'll take a quick look there. Think about it for a second and then share what's top of mind. Thank you for adding glacial. Right. It seems like you're all just still thinking about, I'm gonna long-term strategy and business opportunity. Yeah. Resilience, investment, risks, sustainable growth for all kinds of reasons. The some of the stats we'll look at, the effect on the economy overall, operational uh, efficiency and resilience. Great. Supply chain. So these are the costs that you'd want to avoid through climate action, or the opportunities you'd want to take advantage of um, through investment. Uh, Showing support for issues that are important to humans. Can we just quote this one? Right? Like, does it all have to be financial when we're looking at something that is so tied to human well-being, right? It would then fall into the ethics, justice, or future generations category. And I see that one's getting a lot of support. All right, thank you for this. I think that I got involved in climate work in 1999, if you can believe it. I've seen a lot come and go and swings in political will. Believe it or not, around 1996, 1997, we had a supermajority of Americans convinced climate was a problem and needed urgent action. Truly, it has really changed, and the terminology has changed, and then changed again and changed again. So I'll encourage you to bring that long-term, bigger perspective. This is one of the hardest things a society ever does, and the reasons have changed over time. But I think it's really important for you to be super clear on the reasons and use the deepest argument you can when you, I imagine, will be involved in making the business case. That may be one of the first things you do as an intern during your MBA or as an employee after. That you use as many reasons and as strong a reasons as you can, not the easiest ones. For example, we're coming off a wave now, I would say, where reputation was one of the biggest arguments. Let's get on board with the general trend. And then if that gets complicated or shifts, you've lost your business case. Whereas if you have as many planks as possible, you can withstand the swings or the doubts or suspicions as the general public or as decision makers and policymakers see things differently. Does that make sense? All right. So one of the things I find helpful and very difficult for business people is to look at an aggregate level, to look at the level of whole societies, civilization, the globe, right? This is global warming, global climate change, global impacts. And some of the best work I've seen lately is framing this in terms of the costs of inaction. So I'd like to anchor us on this. This is from a report. I'll share my slides, and the sources are all at the bottom. This is from BCG and University of Cambridge, some of their work on projections, showing that the net cost, aggregate cost to GDP over the next 75 years in red there, their best estimates, not counting tipping points, is a reduction of 15 to 34% of GDP. They are really trying to show that the best they can tell, this is that the costs of inaction are extremely high, and that amounts to a lot of human suffering. And that's not going to be evenly distributed, and that will be on our conscience, right, if we don't act. And they show that investing in adaptation or mitigation, the bright green in the middle, 1 to 2% of GDP through that whole 75-year period would reduce those costs to 11 to 24% from the economic damages avoidable through mitigation, and 1 to 6% through damages avoidable through adaptation, leaving 2 to 4% that are unavoidable. So it seems pretty economic, right? Anybody question whether this would be economic to spend that 1 to 2, maybe 3% of GDP to get there? And this, from an individual business perspective, we're already seeing the costs. Some of the things you all talked about, just as context here, when we think about the need and the critical role of policy, we're already seeing supply chain disruptions, commodity price volatility, right? The war in Iran is a big one, but there are many others. Damage to physical assets and insurance costs, right? The insurance industry is arbitraging what the expected costs are and the premiums they need to charge. Now, one of the tricks here is that in order to increase that investment, one of the biggest, most structural challenges is that the vast majority of it needs to happen in the next 25 years to reduce suffering and costs in the following 50 years. So we'll be paying for grandchildren, and absorbing the cost. So they're saying at this point, they're projecting we need to put 7% of global GDP on a steady basis until 2050, but that this can be covered by the existing investment, which is about 1%, reducing investments in fossil fuels or subsidies to fossil fuels, and then adding dramatically accelerating investment. I mean, it's still very high, 5% of GDP. That's, sorry for the analogy, but that's wartime mobilization of investment in mitigation and some in adaptation. But it does require shifting these investments in fossil fuels or the subsidies to fossil fuels, which is a policy issue. However, when you get down to the company level, it's really hard. And this is where the incremental efforts of every individual entity don't automatically add up to that aggregate level. And one thing I'd encourage you to do is keep that in mind, is this adding up? I think you may have heard in the news lately, this report just came out, I think last month, from the Conference Board, which is a good source of survey data from senior executives. 84% of S&P 500 have a climate target. As of 2025, 58% of those with scope 1 have flat or a rising emissions in scope 1. 62% that have targets for scope 3 have flat or rising emissions. And then 40% in their scope 2. So the utilities, the sources of energy, where they're purchasing energy, they have made much more progress. And that curve is likely to accelerate from what this report suggests. But it's still very, very hard. And the number one barrier, I know the type is a little bit smaller, 55% suggest that financial barriers, the ROI, the capital allocation, the cost to do the investment is the barrier. And I think you will find that the people I talk to inside sustainability functions struggle to make the business case, number one, strong enough, number two, provable enough, and number three, it has to pass the hurdle rate of all the other projects that the company could invest in. This is one of the major weaknesses. Someone told me in a materials company, they have to have a designated budget for sustainability investments, because otherwise, even though they're positive, they're not positive enough to rise above other investments, such as in new products, software, even fossil fuel infrastructure currently. So we have this disconnect between the dramatic need to accelerate to avoid huge costs. At the same time, companies are facing near-term real difficulty in meeting their targets. This is where you'll hear some trends towards measuring energy intensity instead of having an absolute target. Salesforce went to this, which is for every dollar of revenue, we'll have fewer emissions, but that doesn't mean our emissions will actually go down because we hope to grow revenue. This is leading to a trend in the US, very popular, and the US is a big driver and is influencing policy in other countries towards energy realism. Has anyone heard this? Just pop in the chat. You will hear arguments. The American Enterprise Institute has a stream on this. It's come up much more frequently. This source from the Brunswick Group says the mentions have risen over the last 10 years dramatically. So this term of let's be more pragmatic, let's not be so ambitious. You can't turn off fossil fuels. We need all of the above. And so you'll look at this and you'll see that they asked investors what they would invest in. Number one is solar in the US, and number two is oil. That's completely different from shifting investments in fossil fuels towards mitigation of climate efforts. Natural gas is three. The UK is slightly different and UAE is slightly different, but the US you can see right there in the violet line. And the biggest challenges, this is a very interesting chart in my mind. The biggest challenge is just if you zoom in and you look at energy costs, those are too high. And this is the reason for energy realism. This is the bulk of the argument is we need affordable energy and we need secure energy. We can't afford sustainability. And I'll get to in the moment, but I'll invite you to think about the logic errors. I see logic errors in that argument because that first chart showed that all of this will lead to pressure on society, insecurity. Think about the migration that happens when people lose water, the ability to grow food. All of this will affect affordability and sustainability in the long run. But in the short run, these higher energy costs that might be involved in investing, say utility charging ratepayers to invest, is one of the major barriers to the transition and calls for energy realism and some investors then increasing their investments even in coal. So we have a tension between these two. I would say largely because the micro level for companies is not yet proving out financially. It's not obvious that this is a winner. So how do we make sense of this? One of the best sources in my mind is this group called We Mean Business. They have dedicated to climate policy action and speak very clearly across different ideologies about the ethical and business case, mostly business, but they don't drop the ethical aspects of it. And their narrative for this is that we're trying to make the transition. We've made the targets before establishing the systems needed to deliver them. In that last chart about investments, grid connectivity, transmission lines, permitting, all of these other factors, a price on carbon, which I'll get to in a moment, all of these factors are the system on which business depends. So this is probably this came from a professor at Harvard. Probably one of the most important pictures in my mind I would invite you to think about is this assumption that private enterprise delivers for society, people, planet, and profit because it competes on a level playing field. Does that sound familiar? Or when business competes, it competes to create value for society and for itself. And does anybody take economics 101 in their undergrad? I remember I did. I had to go back to chapter 1. There are all these assumptions for that to work. And I would ask you, but I'm just going to plow ahead. One of the first ones is what they call full cost pricing, which basically means no externalities. And I'm going to assume have you heard the term externalities? Think about it this way. If we're playing hockey and you're sitting in the stands and the puck comes out and hits you in the head, right? That is a side effect of the competition that you didn't opt into, right? Or maybe you signed a waiver when you went to a hockey game. But the idea is it's a third party that pays a cost for an economic transaction. And this is a recognized breakdown in whether free markets can deliver for society. It's right in the textbooks, it's in the premises of capitalism, that if you have unpriced externalities, people can be making money while destroying value by creating harm. Pollution is the most obvious example. Milton Friedman talked about this. It's old school textbook stuff, but it's still a very important aspect, and I'll get to that in a moment. The second one is markets depend on accurate information. We're hearing a lot of that about right now about is NOAA going to continue to track ocean temperatures and publish them, et cetera? What do markets need? Even investors needing to know what companies are doing with their climate investments. You need free competition. If you have monopolies, they can capture value without creating value. And then lastly, you depend on public goods. You depend on the largest investors, the largest entities, government, to build things like bridges or the internet or energy transmission lines or things of that sort to secure the grid, to have national security. So there are a lot of conditions for the playing field to work, and public policy, and I would lump in that budgets, public investment, is the way we create that level playing field, along with a few other things like sharing information. But even that is often needs to have a standard and needs to have one rational gold standard for information. It's one reason the SEC rule right now, where companies are having not having to report their climate risks is really important to the information investors would need. And those public policies are set through civic institutions, government, national, state, local, international, and those are informed by societal relationships and civic discourse, how well people are educated, confident, secure, and those are all supported by natural systems. So what I'd like to leave you with in this framework is that business rests on systems, and business influences those systems. And that's one of the main reasons for you to be thinking about public policy as one of the avenues for influence. This is what this looks like from a company perspective. And this is a report by KPMG. I have to say, KPMG, EY, PwC, and Deloitte have all published things that point to externalities and the potential for free markets to work, to guide investment, to serve society, and to decouple it. And this one is one of my favorites from KPMG. It basically says, if you are an individual company trying to act on climate when the playing field is not level, when there's no price on carbon, when there's no price on plastic waste, when there's no cost to the current trajectory that is not sustainable, it's very hard to compete on your own. If you look at this, it basically says you have financial accounting in the blue, revenue minus cost leaves earnings. And then you could say there are some positive contributions you make to society beyond that, say paying taxes. And maybe if you operate in environments where there are kickbacks or bribes, there's some detraction through corruption. Then there's socially positive things you do that you don't get paid for, such as maybe educating your workforce, paying for healthcare, contributing to infrastructure. And maybe you're paying a non-living wage, and that's hurting the communities you work in. Maybe you're introducing health and safety risks. Maybe you're introducing pollution that affects healthcare. Maybe you're contributing to recycling and renewables. That's a positive that you're not getting paid for, maybe through reputation, but not directly. And maybe there are economic and environmental costs that you're not paying for, that society is paying for, such as through greenhouse gases, use of water. We see this now with data centers, raw materials that are depleted, or waste. So this is basically an accounting for all the stuff that doesn't get captured in the P&L. And there are different ways to measure this. I'm sure you'll learn lots of them. GRI is a good source for this. CSRD in Europe is attempting to make companies capture these other impacts, at least as an information for people to know who they want to do business with and where they want to work and where they want to invest. The main way we address these is through public policy. There are voluntary systems, but as we've seen with the Net Zero Banking Alliance, those can fall apart when political will or when there are challenges. So there are a range of public policies that can be used to correct for that uneconomic situation where you're not getting rewarded for value and you're able to externalize costs. Historically, in the last 20 years at least, most of the focus has been on things to correct for information gaps, the far left. So disclosure of your scope 1, 2, and 3 emissions and the pressure to have a transition plan and targets, green taxonomies that have you basically be rigorous about what you count for green activities or clean energy, codes that you might have to adopt. There are national targets, but then again, that's at the aggregate level. And there's a growing shift towards real economy regulation, which corrects those externalities directly. One of the most common versions of this is carbon pricing or a fee and dividend system, cap and trade, things like this that actually just give you a reward if you reduce it and make you pay if you continue to pollute. And then there are sectoral level subsidies, public investments in the grid, you see here, standards. And the idea is that these all create the rules of the game within which businesses compete, and they ensure that you get rewarded when you create real value. Here's the surprising thing. In 2017, in 2008, in 2003, there were conservative plans launched to correct for these externalities, for this right side of the suite of policy options. One of my favorite is this gentleman, Jerry Taylor, and he says the basic need for limited government to a limited government approach to addressing climate change is a carbon fee and dividend, where every member of a society would receive a dividend for their share of the climate. And then they would pay higher prices at the gas pump for spending it on something that had emitted carbon. And his primary argument is that this is free market based, addressing externalities. So this is not opposed to the most rigorous limited government voices. Unfortunately, that group called the eco-right was not really seen much by the progressive faction in the US, at least, acting on climate. And so their actions did not get the support that I think they should have, in my view. It's important to take a deeper look at this. And now we're seeing that these policies can either be harmonized or in conflict across jurisdictions, across geographies. For example, US, federal, state, and local are all diverging. And it's really important when you think as a company, should I support a policy in California that I don't actually really want, but it's the only way we will get regulation at a federal level at some point, such as Scope 3 emissions reporting, when it's not happening on a federal level? Should the US engage in the EU as they're going through simplification of their emerging regulations in the CSRD? And I'm sorry, I know I'm supposed to give the full acronym, and I don't have it at the tip of my tongue. Can you jump in, Jessica?
Yeah, I'll throw it in the chat. Go ahead.
Okay, great. So in this suite of policy options, this survey, this is from, I think, 500 businesses around the world through the World Business Council for Sustainable Development, and 70 interviews with business people. Their quantitative data shows that businesses most want stable long-term policy strategies and frameworks that a basis for thinking about this as to who will have jurisdiction, how we'll measure it, what our philosophy is. Will it be interventions with subsidies, or will it be a carbon price? This general direction is the thing they most want. And then second, there's a range of policies that would help them: incentives to producers of clean energy, investment to reward investment in clean energy, or EV mandates, things like that, to subsidize demand as people make the transition to overcome those costs that we saw earlier, along with still a persistent focus here on carbon pricing or carbon markets and harmonization. They actually mostly prefer, if you can read the fine print here, gradual but predictable policy strengthening to lower, not having the full hit in the near term, but gradually, incrementally increasing the demands for policy. Think about this as if you had a price on carbon, that it would steadily increase over time as companies were able to innovate and adopt innovative clean tech. Here's a recent example on that larger framework. Anybody familiar with the endangerment finding and how this was rescinded, I think earlier, I think it was in February of this year by the EPA. And what I'd like to ask you to do is to think about these and think about your colleagues in your classmates in business school as to how they're interpreting changes in policy and regulation. And the EPA, in rescinding this endangerment finding, is basically a 2009 ruling by the EPA that says the 1970s Clean Air Act includes carbon as a pollutant. And that was critical because without that, they had no basis for regulating power plant emissions, for implementing EV mandates, for setting standards for emissions for cars, the CAFE standards for cars. All of that goes away if you are not regulating carbon as a pollutant. And think about this, and we need to consider all the arguments here, because if we don't engage those who disagree, we will not break through this. This has been oscillating, as far as I know, since 1996. So we need to engage each other on the real objections. So the argument from Chris Wright and the EPA was that the endangerment finding in 2009 under Obama was driving a political goal, a personal preference, a faction of the US wanting to work on climate with a particular lens. and that eliminating it would reduce energy costs for Americans, costly emission standards, costly mandates, costly regulation of utilities, and that it was unjustified because the emissions were contributing some unspecified amount to pollution, creating unspecified harms to the health of Americans, and that they should only be regulating things where there's a clear line between the pollution and the harm in a local way within, say, the US or a region. On the converse of that, the World Resources Institute is another great source for you, has a nice explainer here that basically says it underpinned all the things I just told you. It underpinned all of these other regulations that would level the playing field or create incentives, right? Either interventionist or correcting for externalities. And then you have a group called Ceres, which has been lobbying since 2008 with business people from across the political spectrum. I personally know one of those people. He's still at the White House lobbying, arguing that this is a shared concern and everybody's grandchildren will care about this, is that the endangerment finding allowed the US to stay competitive. Um, it allowed us to foster clean air, which has been a priority for the administration, and then it allowed us to invest in US manufacturing, say, of EVs. Um, so here's a question for you all to think about. Now we get down to the real background question, which is, should business get involved? If you worked for a large company, would you suggest they lobby to restore the endangerment finding? To allow regulation, to allow EV mandates, to allow coal power plants to face pressure to cut their emissions or to shut down? And what principles should guide their engagement in a highly politicized, polarized environment? So I invite you to think about that for a moment. Maybe just jot a note to yourself, and then I'm going to wrap up and we'll go into questions and discussion. Do I have time for 2 more slides, Jessica? Okay. Think about that for a moment. What principles should guide you when you might be accused of tipping the political scales, playing games, driving a political agenda? All right. So the work I'm most proud of in my life is the chance I got, and this is how I first came in touch with ClimateCap. It was hosted at University of Michigan and the Ross Business School and the Erb Institute. I had the honor of working with Tom Lyon when he was the faculty director at the Erb Institute. He had coined this term, corporate political responsibility, and proposed that in addition to transparency and accountability, which basically means standing behind your commitments and not greenwashing, not contradicting yourself in your political activity, he proposed that there was another level of political responsibility or principles that people needed to consider. And my work was to engage a task force of corporate executives from 7 major companies and then 42 activist groups to try and see if we could turn Tom's ideas into a set of principles. And I'm happy to say, and I'll share the link later, we created the Erb Principles. Again, got testimonials from 42 activist groups after 13 executives worked on these for a year and a half. We came up with 4 principles that are critical when companies engage on climate to be trustworthy and to actually keep themselves honest. And the first is to make sure you're clear. You see on the left there on the basis for your engagement. Why are we getting engaged in this? It may be because you've made a commitment and it's why people invest in, buy from, or work for you. It may be because historically you've contributed to a problem, or it may be because it's of such consequence that it matters to everybody in the society, which I would argue climate probably covers all of those. And then we said you need to be transparent and open about what you're doing and why to allow people to have choice. You need to align with the commitments you say you believe in when you engage on policy. And finally, you need to make sure you're having a net positive impact on the systems that I described earlier. And the most obvious one is that if you engage, do so in a way that enables a level playing field, that doesn't reduce information, that doesn't increase externalities, that doesn't reduce competition, and doesn't harm public goods that you depend on. Right? It's basically the ethics that come from the economics textbook. It's a really good place to start. It actually covers a lot of the concerns people have about business influence. There is a community emerging around corporate political responsibility or responsible policy engagement or positive policy engagement. All these terms are being used. And so these are some of the groups working on those. I'm happy to share. And then as you go forward, one of the things I'd like to offer you as a resource is the CPR Hub, which we publish at Third Side Strategies, that tries to explain some of the arguments for this from across ideological bases, a showcase of tools over time, insights that explain some of the tensions and debates on this, and then toolkits to embed this in your company. And you may actually find your company wants to try one of the toolkits we have right now. So you can sign up here to stay engaged and learn more. Check out the resources in the deck, which I will share. And then you can ask your company a couple of questions that might spark some thinking. I actually want to correct this one. My first one is, are we playing on a level playing field? If you hit a problem with a business case, just ask, are we playing on a level playing field? Is there an externality here that's not priced? And should that become one of our goals? Companies like Danone, they're advocating for pricing methane and including it in national targets for climate. And then they're working to reduce methane emissions in their dairy production and their agricultural production. And then the other is you can ask if your company has a responsible public affairs engagement policy, which is what our toolkit can help you review and upgrade if you have one. All right. That is all I have. Thank you. And I'd love to hear what this sparks for you, just anything at all. What are you taking away? What questions do you have? And if you had to come up with your own principles, to my question earlier, if you thought the endangerment finding or something like that was important, what principles would you need to adhere to engage without blowback or to stand by it? Should I turn off the slides now?
Yeah, you can turn them off. I've got some questions queued up here that have come in, so I'll
Great.
ask them. Thank you so much for that. I really appreciate it. I know it's a very complex topic, but I appreciate how you kind of framed all of that for us. And I did throw the link in to the Erb Principles into the chat, so everyone should have that
Great.
as well.
Great.
So there's a couple questions around what do we as individuals do? So you started to touch on that kind of at the end, but I was wondering if you could go into a little bit more detail, as students go into their first full-time role, who are the people within the organization they should be engaging with? What are some of the questions they should ask? What could that look like?
Yeah, yeah. So it requires a lot of creativity. I think the first thing is to keep in mind this disconnect. Did anybody see Back to the Future where you're like trying to connect the cable, right? And it just doesn't reach. To keep in mind this disconnect between the macroeconomic, urgent, clear need for action and the micro, firm level difficulty of forming a business case that's convincing. And just understand that. Don't take it as a personal failing. Don't self-flagellate. And then start with your CSO team. Just ask the question, what should we include in the business case? Should we include our contributions to macro issues because we have an interest in them, and if we do it, maybe others do it? How does this guide our public affairs and our government relations? One of the biggest levers, and there are tools on our site, one of the biggest levers is how are we advising our trade associations to lobby? I mean, trade associations, some of their primary issues are tax relief or immigration exceptions for high-skilled talent. What about these macro, where the costs of inaction are so high and we are working collectively in an industry or across industries? They tell people I know that they're not hearing it from their members. And that's one of the main ways companies can work together to get the rules and policies they need. But you're speaking on behalf of the whole system. So ask the question, and then if you can't get that on the map, and I'm hearing right now it's hard to get it on the map. I talked with one CSO and we said, what if you created an orphan list? If you create the business case, this is very, very micro. Create the things that pass the hurdle and then keep a menu of things that would help the aggregate, but don't pass the hurdle. And just make it really tangible of like reducing our emissions so that we're not part of the global, even though we personally, our company won't necessarily get the benefit. Keep that on the list.
Yep.
So
No, that makes sense. And one of the questions, kind of just to build on that, and kind of from what I'm hearing from you, is the question was, how do we know that we're actually doing the right thing? I think it's not so much you as an individual knowing you're doing the right thing. To your point, it's asking the questions collectively with the people who are engaged in this to have those discussions. So it's not one person's responsibility, it's of the collective.
And I want to flag, it's really hard to make that case, but your ethics classes can help. One of them is, would it benefit us if everyone else made the same decision we're about to make? It's
Mhm.
Kant, right? It's you don't do what things you don't want everyone to do. So if everyone takes a narrow, short-term approach, would that be bad for us or good for us? Is one way to raise the collective interest. So go ahead, you have another question.
Yeah, absolutely. Um, I, I don't know if there's an answer to this one, but it's there's a lot of pushback in driving the idea that a lot of the things we're seeing within climate is uncertainty. We just don't know. Why would we try to just basically dispelling that this is a real thing? How do you have any tips, or have you seen any successful campaigns to kind of move past that paralysis, despite the fact that we're always going to have uncertainty? This is always going to be a gray area.
Yeah. Yeah, so a couple of things. The first one is to take from systems thinking, which I believe you all are interested in. It's a theme. It was how I got into this, is to say when you have increased uncertainty, a broader range of variation or turbulence, that's data.
Mm,
And what we're seeing is that uncertainty is increasing, and we are adding to the uncertainty, and that increases the range of possible trajectories. And it's not exogenous, right? We are increasing the uncertainty. The other is look up Jerry Taylor. He was, I think, the architect of the conservative case for a fee and dividend. He has a couple of talks that I love where he's the one who talks about externalities. And he actually was convinced, he was the former head of the Cato Institute, but vehemently opposed to action on climate. And it was through conversations, which if you ask the questions, you may be that person. Conversations behind the scenes where he realized I can't, insisting on a precise answer is business as usual thinking.
mhm,
If I look at the range,
mhm.
I can see the need to take prudent action, especially when I look at the severity of the range.
Yep.
And then he says, which I think is very smart, he says, people think this way depending on the topic. And so someone who might not think that way around environmental issues tends to think that way around terrorism or cybersecurity. If there's a range of uncertainty, I want to lock it down. If there's a 1% chance that we're going to be welcoming violence, we need to lock it down. So depending on the topic, we do think in precautionary ways and we do address uncertainty. It's just that our political biases lean us to apply it differentially, right? Differentially. So,
I know we're running out of time, but just a
yeah.
quick follow-up. Why do you think that is not the case for climate as it is for terrorism or some of these other topics?
I would say we're doing one of the hardest things a civilization ever does, which is the basis of our prosperity and our lifeways and our identity. We're asking ourselves to accept ownership of changing it, and maybe we were wrong, and maybe we are a big part of the problem. Um, and some people in our society have had longer and more willing to take that on, the cognitive dissonance of that, and others resent it as coercion. Um, and then at different points, we used it as political identity. We can't afford to differentiate on this. We have to be willing to welcome and embrace. And can I give you one practical way you might apply that?
Please,
If
please.
you have a company that says, I don't want to work on climate, we have to do the business case. I would just say, let's do an objective assessment of risks. Every job is a climate job is one of
Yep.
my favorite mantras. Go in and think about ranking risks and back into climate, back into other environmental issues by an objective assessment of risk, right? That is not hitting somebody over the head.
Yeah.
And people resent being hit over the head. All of us do. So,
Absolutely. I think that's a lot of the talk of resilience, right? The still happening. We're just reframing what we call it. So
except we are lowering the aggregate.
it's
That's
true.
so I like the reframing, keep going, and we got to keep that aggregate in mind.
Makes
So
sense.
thank
Well,
you.
absolutely. Unfortunately, we have to wrap up there. I wish we could keep going, but I thank you, Elizabeth. That was a fantastic conversation. We really appreciate you taking the time to talk with us today. So
My
I'd also like
pleasure.
to thank all of our attendees for joining us and give you a quick preview of what's coming up next. In about 15 minutes, we'll be talking through sustainability standards and frameworks. We just talked about CSRD. I bet you you're going to hear a whole lot more about that in the next session. So come learn from that. And then we'll be talking about understanding energy and energy systems and the global transition at one. So that's where we're headed from here. Again, thank you, Elizabeth. Thanks for being here, and we'll see you all soon. Have a
That
good
sounds great. Thank you for having me.